be, I believe, the 79th or 80th time the debt limit has been raised. As parents, even though yours are very young, if your child could not stay within their means for a whole half century and had to raise their debt limit 78 times, can you really trust anybody with that type of responsibility financially? I think that's always the bigger concern. It doesn't get spoken about, but the fact remains is that this is a government that has long since done away with any financial true responsibility on both sides. It doesn't come from one party or another, and they'll come to an 11th or 12th hour agreement, and they'll kick the can again. The problem is one day they're going to go kick the can and it's not going to move, and we're closer to that day than any other time before. It's probably going to not be able to be kicked maybe once or twice more. We cannot continue to have multi-trillion-dollar budget deficits. I started in 1984 in the brokerage business. We were the world's largest credited nation. And if anybody said to me then, Peter, 40 years later, you're going to be having an interview and be talking about potentially now in the next 10 years, $50 trillion in hard debt, not counting Medicare, Medicaid, and Social Security, it just boggles the mind, and there's really no financial responsibility anymore, not only just in federal government, but on many state and local levels as well. If people would just try to understand what a trillion means, and we have 32 trillion of them right now in debt, we're getting to the point, and it's serious, and this isn't scare tactics. I don't have some hard asset thing to sell or want people to buy some guns or ammo for me, but the bottom line is we're getting to the point where servicing the interest rate is going to become, the interest is going to become a huge problem. Our best year, 2019, just before the pandemic, I think we took in about 4.6 trillion, I think the number was. I could be wrong on total revenue. We'll be looking at, if we get to 50 trillion where the CBO says we're heading, and we put a 5% interest rate on it, we'd have half our total revenue going just to pay the interest on our debt, which is unsustainable. Can't function that way. So somewheres, and certainly in your lifetime, I'm a little bit older than you, but certainly, unfortunately for your children especially, we're going to face a far worse crisis than we're going through at this moment. Just ask somebody 10 years ago, there's been a wide range of, and you have many of them on, who've talked about this issue for years. And it probably went a lot further than most of us imagined before it got acute, but we're really in the acute stage now. And how I know that, how I decide on myself that's the case, is because many people in the world now are trying to disassociate themselves from the United States. That's why there's such a movement to join the BRICS and other things like that nature, because people realize the end is in sight now, and they don't want to be forced down with it. They want to get further enough away from the sinking Titanic, so when it goes down, they're not taken with it. During the Roman times, there were Roman leaders that said, don't worry about it, we're going to be kings forever. And I'm certainly with people in Great Britain that once said, hey, don't worry about it, we're always going to be the world leader. I don't know if it's going to be a total change. I don't know if we're going to get a total replacement. I can tell you this, which I'm certain in my own heart, is that we are going to have competition. We've already seen the dollar erode in terms of how much it's used over the last 10 or 20 years. It's going in the wrong direction. This particular administration, I think, has helped accelerate it to the direction. So whether or not it's a formal change or just a competition, there's no question about it. And this is a thing that most financial advisors, I find, cannot decipher. They don't understand the geopolitical ramifications on what's happening. Just look at the Middle East. It wasn't too long ago when it was at least acted like we were welcome in open arms. We're not anymore. We're seeing countries that weren't even speaking to each other coming together because they want to move away and disassociate with states. And that's just one part of the world. We can go in other areas. So the geopolitical ramifications are just as severe as the potential monetary ramifications that's coming down the pipe. Let's just think about it, just starting from the pandemic. When they flooded the economy with all sorts of money, and there was political pressure bar none for them to do so. It's economics 101 if you ever study money, that can't put all that money into a system and not expect we're going to have some inflation from it down the road. Then, of course, the battle for supply has become acute. People realize that all the things that we think and would be readily available weren't, so that helped rise prices. But then let's not forget they actually had a chance to act, and instead they said, no, there really isn't. They used a word that I'm certain has been taken out of the dictionary down at the Fed, and that's transitory. We'll never hear a Fed official use that word again in our lifetime. They missed it there too. And then when they did start to raise interest rates, are they telling me that they had no idea that these banks like SVB and others are out there with substantial paper losses? Because after all, they They're supposed to monitor them and be following it. So I think people give the Fed too much credit. I find it very concerning that there are the people responsible for our monetary and have really been on the wrong side of things most of the time. And you know, there's been people that have called for the dismantling and all. That's just not going to happen. But I can tell you that I would certainly listen to more private forecasters that I follow before I listen to anybody and believe what I'm hearing from the Fed is the truth. Last November, there was a huge survey done by the Fed of banks, including SVB, and they got a check mark. No one said anything. And that problem at SVB didn't just start after November. But it's not alone. And let me tell you this, the biggest concern I have is this talk of insuring all depositors. If you want to open up a can of worms, just make that the case. And if I'm running a bank, I'm going to turn to my other partners and go, listen, let's buy soybean futures. Let's gamble, because after all, if we lose now, Fed's going to step in and guarantee all our depositors. The worst scenario. You have to remember, the deposit insurance was created for the small person, the person that didn't have a lot of money, that they can have safe of mind and not be concerned and have to put it under the pillow. And people that they now want to assure and that they bailed out, believe me, most of those people, even if they took the losses that were losses, were still going to live a better life than you and I are living right now. I think this is the most toughest one to call that we've had to call in the last year. I think there's ample reason to argue that they should at least pause. One thing that is clock kind of going against them is they don't want to get into the real presidential race environment and have to be raising rates if they don't have to. That's one environment. So there may be a thought in their mind is, hey, even though we don't maybe need it, let's just do one more to be certain, and then by then hopefully all the other things that we're hoping to turning down. So that's why I would call it a flip of a coin right now. But I think what's important to recognize in it is that they still destroyed the fixed income market. It is still a challenge, even though very, very short-term interest rates are up. It's still very hard for someone to secure themselves with guaranteed income that's above inflation. I mean, think about it. The 30-year is under 4%, and at best, because I don't believe the inflation numbers that come from the Fed to be 100% truthful, at best, we make it down to 4% in inflation. The 2% number, we would need a depression to have that number again. So I think there's still issues no matter whether they pause or continue rising. One thing I think it's important to remember, this time last year, the don't worry, be happy crowd on Wall Street was already predicting by this time they were already flipped. And that was the reason why you were supposed to buy stocks last year. Of course, they pushed it out another year now, and like a broken clock, I guess they'll be right one of these. I've not been in the camp that still exists at 30, 40, 50% more to the downside. But I'm also not in the camp looking for a 50% upside move. I think markets are basically going to get locked into trading ranges for the foreseeable future, and I mean for the next few years. One thing I'm fairly certain, and of course my own self, I've approached it that way, is that we're not going to see the type of returns that were offered past 10 or 20 years. And that's going to impact a lot of people, especially people that retired, because they built their lifestyle and their plan based on that. And I think we're going to see that become more challenging. But I do think that there's enough bearishness already out there that they'll use the settlement of the debt and potentially a pause to get a fairly significant stock market rally. But it'd be a rally that if I was still long a lot of general equities, which I'm not, I would use to get out of, not to increase my exposure.